Okay, finally, it looks like it's working. All right. Right, so we're basically in the, where am I, 8? So we're actually at the second last topic. So technically speaking, the final exam. I know you're like, what is this? It's so sad. There's only a few more weeks now, I know. But, which means that technically the final exam will only cover 3 topics. It seems weird, but what I will tell you is that these 3 topics are, technically there are 4 topics. I mean, today is basically 2 sessions crammed into 1. So it's a very condensed one. If you look at the readings, it's like 100 pages. Some of you might not do the reading, but again, I would probably recommend it for this week. But again, so basically, so next week we have relative valuation when we're talking about multiples. After that, we'll have a week when we're effectively just trying to make sure that everybody finishes the group project. And then after that, probably presentations and a review. And then you're basically done. Yay! But today we're doing is effectively cramming 2 sessions into 1. So it might be a bit extreme in terms of the amount of information. The good part is part of this you would have kind of been exposed to. So today what we're doing is we're focusing on intrinsic valuation. So we're actually going to be using some form of a valuation model to try to value your business. And again, intrinsic valuation, I think we actually had this question on the exam. So what is the difference between intrinsic and relative? Which one is better? Well, intrinsic is just trying to understand the value of an asset by looking at its characteristics and all essentially the inflows and outflows. So you're trying to understand the returns it generates and the risks associated with those returns. And again, we're trying to estimate the real value because we want to understand what do we actually get from this asset. And when we do that, we're effectively trying to use 2 different approaches in this session. So we're going to be looking at the free cash flow valuation models, or DCF, which is something you would have covered in some other classes. And then the residual income valuation model. Now, have you covered this in any other classes or been exposed to the idea, residual income? No, that's all right. Easy peasy. So residual income valuation is the second type of approach, and it's a much more of an accounting-based approach. But again, we'll start off the free cash flow valuation model, which is, I think, shouldn't be too bad of a review for you, but you will have some more advanced issues here that we're considering. So again, the discounted cash flow model is effectively the most commonly used valuation method out there. So it's probably the one that is always needs to be done when you value a firm. Now, when we're looking at a discounted cash flow model, we essentially view the intrinsic value of a security as a present value with expected future cash flows. So we're only caring about cash flows. If something does not generate cash flows, it usually won't be captured here. Now, when we're looking at the discounted cash flow model, what we want to, consider is really what is the purpose of the valuation. And this is essentially the new bits that you would not have covered anywhere else. And the idea here is that when you value a firm and its cash flows, you can either value the equity portion or you can try to value the entire firm. It seems a bit weird, like what is the difference? So if you think about like a house, so you own the house and you have a mortgage associated to it. You can either value the house itself or you could value your equity portion. So what percentage of it you own and what is the value of that? And that is the same idea here. So when we value a company, we can value the whole company by valuing the free cash flows to the firm. And those cash flows are available to stockholders, but it's also available to the debt holders. So it's essentially the cash flows that are available to all the capital providers. Now, this is also known as an unlevered discounted cash flow model. And the reason why it's unlevered is because that when we value a firm, but according to the free cash flows to the firm, we're effectively removing the effect of leverage. So we're essentially assuming 0 leverage in this case. The alternative way is to value the company's equity, which is essentially just the claim of the common stockholders. And essentially what we're doing here is valuing the free cash flows to the equity. Again, it's a bit tricky and a bit of a tiny little difference. It's going to kind of come to you as you go through a few examples and as we kind of go on and on what the differences are. But these are some of the kind of important things to actually really learn for this week. So again, free cash flows to the firm is FCFF. free cash flows available to common equity holders is FCFE. So there's basically only one letter difference. So you might get a bit confused, but basically you need to make sure that if it says FCFF, it's the free cash flows available to be paid to the common stockholders, but also the debt holders. So essentially, if you borrow money from the bank, that money can then go to the bank. Whereas the free cash flows available to common equity holders are the cash flows that are available to the equity holders after we've already paid the bank. So essentially, it's after we paid the bank, whereas the other one is before we paid the bank. So when we're looking, I guess, which one is more common, FCFF is the more common approach. And usually when people talk about the discounted cash flow model, they talk about FCFF. Now the key highlights when it comes to the differences in calculations is that when we're discounting free cash flows to the firm, we discount it using the weighted average cost of capital. When we discount free cash flows to the equity holders, we discount it by the cost of equity. And the idea here is that because free cash flows to the firm are available to all capital providers, we discounted it by the weighted average cost of capital because that includes both the cost of equity and the cost of debt. But when we're only looking at the free cash flows to the equity holders, we only need to discount it using the cost of equity. Now again, technically speaking, you could value the entire firm, so use the FCFF approach, but then still figure out the equity portion just by essentially looking at the, I guess, the FCFF value, so the present value of the free cash flows to the firm, and then you just subtract the debt value. And the debt value is essentially what you owe to the debt holders. Again, it's all right if you're confused at this point. It's gonna come kind of to you as we go along. So again, when we're looking at the differences, we have free cash flows to the firm and free cash flows to the equity. Again, to the firm, these are cash flows available to common stockholders, debt holders, and preferred stockholders. Whereas the free cash flow to the equity, that is only available to the common stockholders. So again, when we're looking at the differences, is that this is basically an unlevered approach because these cash flows can be paid out to different types of capital providers. Whereas the free cash flow to the equity, we're basically looking at it after we've already paid these two out. So we're only looking at how much is left for the common stockholders. Now, you would have already talked a bit about, I guess, the discounted cash flow model in the fundamentals of finance class and some of the other classes, and you would have seen some formulas before. It's just hopefully some of these formulas are not too tricky. But the idea is that when we're looking at, for example, the free cash flow to the firm, we can express it in an equation approach, a formula, to say that it's essentially the sum of all the future cash flows to the firm discounted by the weighted average cost of capital. That is essentially what that formula is trying to say. But essentially what this is essentially trying to estimate here is what's called as the firm value, and sometimes people call this enterprise value as well. So firm value and enterprise value are the same thing. So when we're looking at firm value or enterprise value, we're valuing the entire business, and we're assuming no leverage. But if we want to know what is the equity portion worth, so how much is the equity part worth for the common stockholders, then we can just take that firm value that we get from this equation and just subtract the debt value. And the debt value is essentially your market value of your debt. So it's what you owe your banks and your bondholders and so on. Now again, you could just value the equity portion directly by taking a similar approach as to the top, but instead of discounting free cash flows to the firm, you're going to be discounting free cash flows to the equity holders. And instead of discounting using the weighted average cost of capital, you're discounting it using the cost of equity in this case. So when we want to actually apply these things, so say we already know what the values are, so say we already figured out how much free cash flows we have available to the firm or to the equity holders, we can then value it using a multitude of different approaches. So the most simple way to value a firm is assume that it's going to be a perpetuity, in the sense that you're assuming that you have a kind of cash flow assumption that you're going to get next year. And then you're going to also assume a discount rate and a growth rate. So essentially what you have up here and down here are perpetuity formulas. So you're essentially assuming that a certain cash flow will continue on in perpetuity, assuming a certain discount rate and a growth rate. So again, nothing too fancy. Now we can also apply this using an example, and I think that's on the next slide. So say, for example, we have already calculated how much free cash flows are available to the firm. And again, if you think about what is FCFF, well, FCFF is basically a different view of profits. So if you think about accounting profits, that is your view of profits. But that does not tell me how much cash do we have on hand that is available to our capital providers. So we're going to make a certain few adjustments, and we'll kind of go through how to do them in the later slides to get to how much cash flows do we have available to, in this case, all the capital providers, so free cash flows to the firm. So in this example, we have 6 million of free cash flows to the firm. So essentially that's the cash that's available. The market value of our debt is 30 million. The number of shares outstanding is 2.9 million. The WACC is 10.23%. And the long-term growth rate is 5%. So essentially all we need to do in this case is plug and play. So we use the formula we had on the previous slide, which is also here on the left. So we take the FCFF in year 1, so in T+1, and then we discount it by the WACC minus the growth rate. So again, we know what the current FCFF is. To get to the FCFF1, which is basically 1 year into the future, we need to multiply it by 1.05 to basically account for the growth rate of 5%. And then we discount it by the WACC minus the long-term growth rate. And that gives you a value of 120.5 million, and that is the value of the firm, assuming no leverage. But because there is leverage, in the sense that there is debt associated with this firm, in order to figure out how much is, for example, one share worth, you first need to subtract it from the firm value. So we take the firm value, subtract the market value of the debt, and this gives us our equity value. The equity value can then be divided by the numbers of shares outstanding to get the price per share. Again, if you're thinking about the stock market, well, the stock market always expresses the value of a firm in terms of equity value, because we're always looking at what is the price per share, multiply the number of shares, gives us our equity value. And equity value and you might already seen it on Bloomberg, market capitalization are the same thing. So they're assuming a certain leverage. Now, the main thing, I guess, to understand for this week is, one, that there's a difference between FCFF and FCFE, but you also need to understand how do we even figure out how much we have in free cash flows. So generally speaking, what we need to do is we need to figure out how much cash flows do we have on hand that can be distributed to either the equity holders or to all the capital providers, essentially to the firm. To do that, we don't actually look at how much cash we have on hand. We instead look at net income and then try to get it back to cash. So I think I've already mentioned it, I guess, in the previous week, even when we did accounting analysis, that over the long term, the amount of cash profit you make and the amount of accounting profit you make should be the same over the long term. The differences from year to year is really timing, because again, from an accounting perspective, if somebody, I guess if you sell on credit, well, that's going to increase profits this year. But if you didn't collect cash, it's not necessarily going to increase your cash profit this year. So there's going to be a difference in the figures for this particular year, just because of the timing of when you receive the cash flows. So what we do when we try to estimate the free cash flows to the firm is we start with net income, and then we adjust it for any non-cash items in the net income figure. So what we start out with is, again, just the net income. That's our starting point. We then add back any net non-cash charges. So net non-cash charges are any charges that would have decreased the, I guess, net income, but didn't necessarily, I guess, result in a cash outflow. The easiest example of this is depreciation. So when you depreciate something, you're not actually paying cash to anybody, you're just allocating a prior acquisition to this period. So essentially just doing an artificial adjustment. So when you've depreciated something, you would have decreased the net income, but in order to figure out how much cash I have on hand, well, I need to add that depreciation back. Now, the second portion is the interest expense, and again, we're in this case adding it back. Can anybody think of why do we add back interest expense? when we are trying to estimate free cash flows to the firm. Confused? You're a bit blank, that's all right. So again, if you remember, free cash flow to the firm, we're assuming zero leverage. If we're assuming zero leverage, there should be no interest expense. So that's the reason why we add back the interest expense. So our net income, it's after we've already paid the interest expense to the bank and all our debt providers. In this case, we want to understand what is the free cash flows available to the whole firm. We need to add it back. The reason why we then take 1 minus the tax rate is because the interest expense would have been tax deductible in the first place, so we need to account for that. We then have two further adjustments, and the first one is the fixed capital investments. And this is essentially something that is subtracted. So if you would have, for example, in this particular year, purchased a bunch of fixed assets, so essentially purchased a piece of machinery or whatever, you need to subtract it from net income. The reason for this is that net income wouldn't have accounted for the fact that you purchased a huge piece of machinery. Because that piece of machinery would only be, I guess, showing under net income or the profit and loss statement in the form of depreciation. But the actual cash outflow of $1 million or 10 billion or whatever you spent on it this year would not be showing in net income. So in order to figure out how much cash we have on hand, we need to subtract any investments in fixed capital. So again, if we purchase a machinery worth 1 million, we need to subtract it from the net income figure to figure out how much cash do we have on hand. And similarly, when we're looking at working capital investments, we need to subtract it. So if you remember from the, I guess even midterm, working capital is effectively the capital that you use in your daily operations. So the easiest way to think about it is your current assets minus your current liabilities. So your current assets are things like accounts receivable and so forth, whereas your current liabilities are accounts payable. And when we're looking at investments in working capital, if you think about, I guess, any increases in working capital. So if your working capital is increased, what does that mean? So if you think about, let's say, selling on credit. So when we sell on credit, well, all sales go up, so our profit goes up. But when we sell on credit, our cash profit did not necessarily go up because we haven't received cash. And this is really what this portion is trying to capture. So if we were to sell on credit, our accounts receivable would go up. When our accounts receivable go up, it means that our working capital goes up. So when we're looking at investments in working capital, what we're essentially looking at is any changes in working capital. An increase in working capital means that you need to subtract it from the current net income. Again, very complicated, and it's not necessarily super intuitive, so I really do recommend the reading where it kind of goes through it over and over again and each and every one. So I really highly recommend them for this portion. Now, in this little equation, we talked about, I guess, net non-cash charges, and I said depreciation is probably the best example, but there are actually many other types of non-cash charges that you could adjust for. So this slide basically goes through other types of non-cash charges. So we do have like depreciation, amortization, which is more or less similar concepts, but if you say, for example, things like capital gains. So if you had a capital gain, let's say if you sold a piece of land or whatever equipment, and the gain on that sale would have increased your profits, well, that gain wouldn't have been associated with any form of cash inflow, so we need to subtract it out. And in capital losses is exactly the reverse effect. When we're looking at deferred tax liabilities, well, the only reason when you have an increase in deferred tax liabilities is when you've had tax expenses, but you haven't actually paid them in cash yet. So an increase in deferred tax liabilities means that your net income needs to be higher because net income is after tax expenses, but if those haven't actually been paid in cash, we need to add it back. And then deferred tax asset is the exact opposite kind of idea here. But the idea here is that you have many different types of net non-cash charges. Now, say for example, we wanted to calculate free cash flow to the firm and free cash flows to the equity holders. And we might get this types of information in the sense that we might find out that the earnings before depreciation and amortization is $1,000. Our depreciation expense is $400. Our interest expense is $150. Our tax rate is 30%. We also find out that we purchased about $500 worth of fixed assets in this year. And we have an increase in working capital of $50. And then finally, we know that net borrowing is $80 and that our common dividends is $200. Now, essentially what you could do is you could then use this equation to then kind of plug and play and try to figure out what the free cash flows to the firm should be. So in this case, the first thing that we kind of need to do is figuring out what net income is. Because we haven't actually found out what the net income is. In this case, we actually have to calculate it using the 4 first line items. So if you're looking at net income is your earnings before interest, depreciation, and tax, minus your depreciation and minus your interest expense. And then you need to account for the tax rate as well. So again, if we're looking at this little slide here, so we have net income. It's going to be based on the EBITDA minus depreciation minus interest expense. And that gives you your earnings before tax. And then you multiply it by 1 minus the tax rate to figure out what the net income should be. So again, EBITDA, depreciation, interest expense, and then we have the tax rate here, which gives you your net income. Now, to go from net income to then free cash flows to the firm, you effectively need to adjust for the differences between, again, cash practices and accounting practices in a sense. Because again, accounting just tells us what the accounting profit is. It doesn't tell us how much our cash profit is. So when we're looking at estimating free cash flow to the firm, we basically use the equation that we had 2 slides back. So we start with net income. We add back any net non-cash charges. In our case, we were only given depreciation expenses as one of the net non-cash charges, so we add it back. We also add back interest expense after tax, so again, 1 minus the tax rate. And then we subtract the investments in fixed capital. So again, we know that we purchased fixed assets worth of $500, and we had an increase in working capital of $50. So essentially, we subtract the increase in fixed capital and the increase in the working capital, which gives us $270 as the free cash flows to the firm. Now, this example is just for free cash flows to the firm, but you could theoretically also calculate free cash flows to the equity holders, because again, these are 2 different concepts. So when we're looking at free cash flows to the equity holders, the main difference here is that free cash flows to the equity holders assumes that a firm has a certain leverage. So the key difference is that we don't add back the interest expense, because this is after the interest expense would have been paid. So the free cash flows available to the equity holders is the amount that we can pay to the equity holders after we paid the interest expense. But the second part is net borrowing. And the reason why net borrowing becomes a cash flow to the equity holders is that in theory, if you borrow a lot of money from the bank, you could theoretically just distribute it to the equity holders directly. So we need to look at if we borrowed money, then we add it back when we estimate free cash flows to the equity holders. Again, this is probably the most complicated part of this week, is just trying to get your head around the differences between cash flows and accounting profits, and then to try to figure out how you actually get to these. Because probably if I look at the previous final exam, what people didn't understand is really why do we subtract this out, or why do we add this, and so on. So understand it from a theoretical point of view, why you need to adjust for these things. Yes? So when we look at non-cash charges, this is basically a list of the most common ones. So the idea here is anything that would have either increased profits upwards or downwards, even though there was no cash inflow or outflow associated with it. Again, if you think about, I think this one is a pretty good example in the sense of deferred tax liabilities. So you have a tax expense on your profit and loss statement that decreases your profit. But if you haven't actually paid anything, what would happen is that you would actually have a tax expense, but you would also have an increase in deferred tax liabilities. So if you have an increase in deferred tax liabilities, I know that there is a portion that I need to add back because that hasn't actually been paid out in cash. Now, I've given an example of like a perpetuity model already when we're looking at discounted cash flows. But generally speaking, when we're estimating the kind of a discounted cash flow model, it's usually a multi-stage model in the sense that you assume a certain growth for the first few years, and then you might have a perpetuity at the end. And it's kind of similar to what you're going to be doing for your own company. So when we want to use a multi-stage model, essentially what this little equation is trying to show you is that we first sum up all the, cash flows that we've, forecasted specifically. So if we forecast specifically, this is how much cash flows we have in year 1, year 2, and year 3. We discount them back to the present period, sum them up, and then at the end we have a perpetuity. So the final kind of part of this equation is really the perpetuity. So if you look at this part, for example, that's the perpetuity of the free cash flows to the equity holders. And then because this perpetuity would have been estimated in maybe year $5, we then need to discount it back to the present period, which is the last part. Again, a bit complex if you haven't actually applied it, so we're going to be applying it in this little example now. So again, in this case, we're going to assume that we have $100 million in current free cash flows to the firm. We know that we have 300 million shares outstanding. We know that the long-term debt value in millions is 400. So we also can basically try to estimate what the future growth rates are. In this case, we've kind of been given the growth rates from years 1 to 3 is 30%. For year 4, it's 24. Year 5 is 12%. And from year 6 and onwards, it's 5%. And then finally, we know that the weighted average cost of capital is 10%. Now, effectively, what we need to do is we need to basically create a little table to figure out how much in cash flows do we get in each particular year, and then discount them back to the present period, each and every one. And then finally, we need to figure out what is the value of the perpetuity or the terminal value at the end. So the first part is basically just setting up a little table like this. And again, if you've done the homework, we've kind of done something similar, but in a slightly different way. But the idea is that the first step you need to figure out is how much cash flows do I have in each particular year. So in year 1, I know that we have $130 million worth of cash flows. The way I know it is I know that the current FCFF is $100 or $100 million, and I know that the growth rate is 30% in year 1. So 100 multiplied by 1 plus 30% gives you 130 million. So similarly, when we're looking at year 2, we're looking at the previous year's cash flows of 130, and again multiplying it by 1 plus 30%, which gives you 169 and so forth. So each year's growth starts out with the previous year plus the growth rate to figure out what the free cash flow should be. When we then look at the present value calculation of each and every one, again, it's a simple discount model, which you would have done a few different times in your degree, hopefully. And that is essentially just looking at the free cash flow. So in this case, 130. And you're subtracting, dividing it by 1 plus the WACC to the power of the actual period that we're in. So in this case, we're in period 1, and next year we'll be in period 2 and period 3 and so on. And essentially all you do in this little equation here for each year is, again, take the free cash flows divided by 1 plus the WACC to the power of the period. So 130 divided by 1.1 to the power of 1 because we're in period 1. The reason it's 1.1 is because our WACC is 10%. So it's 1 plus the WACC, which means it becomes 1.1. So in year 2, it will be 169 divided by 1.1 to the power of 2, and so on. So every year you discount it further and further back. And the idea behind the present values of these cash flows is we're trying to understand that even though we get 130 million next year, the value of this cash flow in today's dollars is only $118 and 20 cents and so forth. So we're trying to understand what is it worth in today's dollars. So this kind of gives us an overview of what the present value of the free cash flows are for each year that we forecasted specifically. At the end of year 5, we're told that the FCFF for growth for year 6 and thereafter is 5%. So that is the perpetuity stream that we're assuming at the end of the period. So the idea here is that at the end of the period, once we're effectively done knowing specifically how much we're making, we're just going to make a simple assumption. So similarly for your own project, we've basically forecasted 5 years specifically, and then we're going to assume a simple assumption of a perpetual growth rate. In this case, it's 5%, which is actually quite large. So what you need to do to figure out the value of the perpetuity is to use a formula that is basically a perpetuity formula. And the perpetuity formula, if you remember, it's looking at the free cash flows in n plus 1, so essentially n plus 1, and then you divide it by the WACC minus the growth rate. So when we're looking at the terminal values and when we're estimating them, we're always going to estimate them at the end of the period of the final period. In this case, the final period is year 5, because we know that from year 6 and onwards, the growth is 5%. So if we specifically figured out the growth rates for the first 5 years, and then we have a simple assumption of 5% of year 6 and thereafter, we're going to be always estimating the value of perpetuity in year $5. So in order to figure out what is the free cash flows to the firm in FCFF in n plus 1, and n just means period, plus 1 means in the basically the period after. So FCFF in year 5 plus 1 means in year 6. What is FCFF in year 6? Well, FCFF in year 6 is $320.40. And the way you get it is by taking the FCFF in year 5 and then multiplying by 1 plus 5%. So essentially that is the growth that we're assuming forever in this case. And then we discount it by taking our, essentially we divide it by the WACC minus the growth rate. So 0.1, which is the WACC, and the growth rate that we're assuming for the perpetuity is 5%. That is essentially the value of the perpetuity. Now the important thing to remember is that this part of the equation just looks at the value of the perpetuity. But because this valuation of the perpetuity takes place at the end of year 5, we then also need to discount the value of the perpetuity back to today's dollars. So that is what the second portion of the formula does. So what we're doing here is we're essentially trying to estimate the discount factor, which is really just 1 divided by 1 plus the WACC to the power of the periods. So in this case, because we're estimating in the year $5, we need to discount it back by 5 periods. Is everybody confused? Because everybody looks like, it's okay.
So
Jacob.
you do this step for each period?
Yeah, what do you mean? Sorry.
So you'd have to do the 1 divided by 1 plus 10% to the power of each period?
No, so in this case, so this is the value of the perpetuity. So the beauty of this is that you're just assuming that the 5% growth is going to continue on forever. So the terminal value is only done for this time. So after you've done this, you're basically done. So you've already estimated the present value of these specific cash flow stream, and then you've estimated the present value of the perpetuity formula that's going to happen basically forever. So you only need to do it once, and that's basically you're done. So the value of the perpetuity here is $3,979, which means that the value of the firm is basically all the present values that we've calculated so far summed together. So in this case, the firm value is basically the year 1 present value, the year 2 present value, year 3, and so on, plus the perpetuity at the end, which gives you your firm value of $4,777. And again, the equity value we can always get by just subtracting the amount of debt that we have. In this example, we were told that there was about $400 million worth of debt, which gives us the equity value of $4,377. And again, if you go back to the assumptions, it also told you that there's 300 million, I think, shares outstanding. Divide 4,377 by 300, and you get the equity value per share of $14.59. So it's a bit technical, but I don't think it's that difficult once you've actually learned the process. So you kind of need to learn the process, but in doing so, you also need to kind of understand what's actually happening here. Because the worst thing you can do, I shouldn't say it's the worst thing you can do is not study at all. But the second worst thing is to just know how to apply the formula without thinking why we're doing what we're doing. So it's important to understand, why do we discount this back 5 periods? Why do we assume that, in this case, that a certain, I guess, growth rate will continue on forever? And even for your own project, you need to figure out what is an appropriate growth rate. So what is the growth that we can assume for the future forever? So even if you think about it right now, so if you wanted to assume a certain growth rate for your project, Josh, what would you assume?
What do you mean?
So let's say you want to assume that the cash flows will grow forever. What growth rate would you choose? Yeah, anybody else? Yes?
What about the risk-free rate?
You can do the risk-free rate maybe. Any other takers? 4%. It's another good guess. Basically, there's no right answer here, but what you need to know is, depending on what you choose, it will have a dramatic effect.
Where would you estimate those growth rates from?
So the growth rates that you have in the first 5 years, you wouldn't necessarily do it this way. You would do it how you've done it in the forecasting week. So in the forecasting week, you figure out how much the sales have grown and so on, and then try to figure out what the net profit will be for each period, and so on. But when we're looking at the final growth rate we're essentially assuming will continue on forever, which is why a lot of people would say you should not go much higher above inflation or CPI, basically. Jacob?
Would it be safe to say that like you could choose a growth rate based on what the industry is growing at? Would that be considered like mean reversion? In this sense?
Yes. The only issue here is that people generally say that it's hard to grow at above the economic growth rate forever.
Oh.
Because here we're basically assuming growth forever. So if I just give you a quick example in, let's see if I can get to Excel, just to show you kind of the impact of assuming a one single percentage point difference. So let's say we have 5 cases where we're going to assume either a 1% growth, 2% growth, 3% growth, 4% growth, and 5% growth. So 5 different cases here. Let's say we have +1, and we'll do this for maybe, again, this is forever, so let's do 500 years and see what happens. That didn't work. Let's see that one. Okay, so for 500 years, we're going to assume a single growth rate to figure out and look at what is the difference in the outcome at the end, just to demonstrate how big of a deal it is. So let's say we start with $1 for each one, so $1 for each one. And for each one, we're essentially going to assume that there's going to be a constant growth rate for that particular. So that's going to be equal to 1 plus this one. I'm just going to lock it. So in this case, basically in year 2, we have $1.01. In 5%, we have 1.05. If we do this for 500 years, the differences will be quite drastic. Because again, we're assuming a perpetuity here. So we're assuming this is going to continue on forever. So let's look at year 500. So the differences are quite dramatic between 1 and 5%. But I don't think a lot of people understand just how big. So 1 is 141 versus, I don't even know, that's like 35 billion, I think, or whatever. So a small percentage change will have a huge impact in the long term. So a lot of people, when they look at, okay, so I need to forecast a future growth rate, I'm just going to shoot from the hip and say, oh, 3%. But 3% versus 4% is going to have a dramatic change on the actual value. So you need to be able to justify it. And again, usually people would say you can't grow at much higher than CPI. So CPI is, generally speaking, one of the easiest assumptions to make. The final 2 things that you really need to consider for the free cash flow model is the idea of mid-year discounting and also then the role of non-operating assets. So mid-year discounting just means that instead of discounting things back 1 year or 2 years, we're going to instead discount it as if we received the cash flows in the middle of the year. So if you remember here, for each period, we take the cash flow divided by 1 plus the WACC, and then take it to the power of the period, so 1. In mid-year discounting, you instead of taking 1, you take 0.5. So you subtract 0.5 from each period. And the idea here is that technically speaking, the cash flows don't magically appear at the end of year 1. They don't magically appear at the end of year 2, at the end of year 3, and so on. It's something that you would have accumulated throughout the year. So because it's something that accumulates throughout the year, discounting it back as if they were received at the end of the period is not necessarily correct. So instead, what you could do is use mid-year discounting, which effectively for each year would discount it by 0.5, 1.5, 2.5, and so on. So essentially remove 0.5 from each year to assume that it's going to be received in the middle of the year.
Do you do that just to align with like the financial?
No, so basically the idea here is that when we're discounting, I guess, free cash flows, we want to know what are they worth in today's dollars. And again, because we would have received some of these cash flows in the beginning of the year and some at the end of the year, you want to, again, if you want to discount them to the present period, you want to know what is kind of the discount rate that you should use. So let's say we actually received all the 130 million on January 1st. In December $31, it's basically going to be almost the same. But if we received it at the very end of the year in December, then technically we could probably discount it back a full period. But because, I guess, again, we don't know exactly when they were received, we're just going to assume they were received on average in the middle of the year, which is why we're only going to discount it by 0.5 for the first year.
Is one more accurate than the other, or?
With the general idea is that when you're using a whole year discounting, you're basically discounting it a bit too far back. Because you would have received it sometime in the middle of the year on average. So instead, if you discount it back by one period, you go back basically in time a bit. So generally speaking, mid-year discounting is slightly more accurate, but it's not going to have a huge effect. The other thing that will have quite a big effect for some firms is non-operating assets. So it's a bit of a wordy slide, but basically it means that if you have assets which are not generating cash flows, you need to add them to your firm value to really understand the value of the firm. Because technically speaking, the free cash flow model will only be able to value assets that are generating cash flows. So if you have assets that are not generating cash flows, they're not going to be valued by the free cash flow model. Best example when we're looking at this is cash. So say we have a firm that has $1 billion in cash, and it's just sitting on a non-interest bearing bank account. That's all it does. If we wanted to estimate the free cash flow model for this firm, and we're assuming that it's not selling anything, it's not doing anything, it basically looks like every year they have 0 inflows, 0 outflows, 0, 0, 0, 0. So when you're trying to estimate the value of this firm, it would be 0. But technically speaking, it still has $1 billion in cash sitting on its bank account. So the idea here is that when we have a huge amount of non-operating assets, we look at the value of the firm as a function of whatever the discounted cash flow model would have estimated, which is really the value of the operating assets, which are giving us returns, plus the value of the non-operating assets. So again, when we're looking at the discounted cash flow model, really one of the big drawbacks is really that it doesn't deal well with non-operating assets. Because again, it can only value cash flows, which are basically generating by operating assets that are contributing returns to your firm. Question, do you want a break? Yep, sweet. All right, come back in 10 minutes and we'll continue then. All right, so we'll continue on and finish off the lecture. So the second part, if you remember, today is basically looking at intrinsic valuation models. And all right, so today basically we're looking at intrinsic valuation models. So we have cash flows, so basically the same cash flows, and the second part is residual income valuation. So they're trying to value different parts of the returns. So when we're looking at the free cash flow models, they're trying to value the firm based on the cash flows. When we're looking at the residual income valuation model, they're trying to value the residual income produced by the firm. And the residual income, it's probably a much simpler concept, because all you're doing to figure out what the residual income is you're looking at the net income and then you're subtracting an equity charge. Because the idea here is that technically speaking, a firm might be profitable in absolute terms. So you might be making like $100,000 a year, but investors are effectively providing you with capital, so they expect a certain return that you need to compensate them for the opportunity cost, which is really what the equity charge is trying to kind of showcase. So in order to figure out whether the firm actually made an economic profit, in order to figure out what that residual income is, you take that net income and you subtract the equity charge. So you essentially figure out what is the pure economic profit that we've made after considering how much we needed to compensate our equity holders. So again, we could think about this from a residual income per share point of view. So say if you want to figure out what is the residual income per share for my firm. So what you would do is you look at the profit on a share basis, you take the earnings per share, and then you would subtract the equity charge. And the equity charge is, the way that we implement it is we look at the cost of equity, so the required return on equity by your shareholders, and then you multiply it by the beginning book value per share. So the book value per share is essentially your book value divided by the numbers of shares outstanding. So everything here is on a per share basis. Instead of looking at per share, you could look at it in absolute terms. In a sense, you could look at what is the residual income in general. Well, that's going to be equal to the earnings minus the cost of equity multiplied by the beginning book value. But again, this slide is just trying to break it down on a per share basis. So again, this is a very simple example of, you might have a firm that is making a profit, but from an economic point of view, from the shareholder point of view, it's actually creating a loss. So again, in this case, we have beginning equity capital, which is the same as beginning book value of 2 million. We have a cost of equity of 12%, and we have a net income of 96,000. So again, it looks profitable, but if we're looking at it from an economic point of view, then we need to subtract the equity charge. And in this case, the equity charge is equal to the cost of equity multiplied by the beginning equity capital. So 2 million multiplied by 12% gives you 240,000. So from a shareholder point of view, in order for them to be compensated for the amount of risk they're taking when investing in your firm, they want to be able to get $240,000. But you're only providing them with $96,000, which from their perspective means that even though you're making a profit, from an economic point of view, you're actually making a loss. So if you remember, even I think in the midterm we did have a question around, when give an example of when the going concern value might be lower than the liquidation value. Well, this is an example of such a scenario that if you think that you'll continuously will make less than the cost of equity, it means that it's actually probably better just to liquidate the firm. Because if you can't compensate your shareholders for their opportunity costs, which is essentially their cost of equity, well, then you're not actually creating any profits. So this is a bit longer example, but it's basically just trying to make you understand it from a multi-period perspective, and basically how you would try to value such a firm using a residual income valuation model. So in this case, we have a residual income valuation model, and we have an example here of Bug Properties, which is expected, has an expected earnings per share of $2, $2.50, and $4 for the next 3 years. So we have a 3-year period basis that we're valuing the firm on. So analysts expect that Bug will pay dividends of $1, $1.25, and $12.25 for the next 3 years. The last dividend is anticipated to be a liquidating dividend, so essentially the firm will cease operations after year 3. Bug's current book value is $6 per share, and its cost of equity is 10%. So based on these inputs, we can then try to figure out, has the firm made an economic profit or essentially a positive residual income in each particular year? So the way we do this is we first start out with what did we begin our book value per share with in each period. So in this case, it's $6. We then look at the net income per share for that particular period, and we were told up here in the assumptions that it's $2 in the first year. We were also told that the dividends for that year is $1, which means that your net income minus dividends is what you basically put into your retained earnings at the end of the period. And at the end of the period, that retained earnings essentially increases your ending book value. So if you're looking at the ending book value per share for each period, it's going to be equal to the beginning book value plus the earnings per share minus the dividends. Because again, once you start paying out dividends, it means that you can reinvest less into the business. So the idea here is that we can figure out what the ending book value per share is for each period, and this ending book value per share will also be the beginning book value in the next period. So $7 ends here, means that the opening value for year 2 is $7. In year 2, it ends with 8.25, and that's the opening value in year 3, and so on, and so on. So we know the net income per share is $2, $2.50, and $4. We're told that. We know what the the equity charge should be. And the equity charge is basically just the 10% multiplied by the beginning book value of equity. So in year 1, it will be 10% multiplied by $6, which is going to be equal to 60 cents. In year 2, it's going to be 10% multiplied by $7, which is going to give you 70 cents. In year 3, it's 8.25, so it's going to be 0.025. So the residual income from each year is going to be equal to the net income minus the equity charge, which means that the residual income in year 1 is 1.4, then we have 1.8 in year 2, and the final year is 3.175. So we've essentially figured out what is the economic profit associated with each period in this scenario. So again, from a residual income point of view, we figured out what the residual incomes are. We haven't actually valued the firm using them. So in order to value the firm using them, we first need to discount them for the present period, but also then consider what is our beginning book value. So from a residual income valuation model point of view, it's very similar to a discounted cash flow model in the sense that we're discounting a return in the future. So in this case, we're discounting the residual incomes, but the big difference here is we add the beginning book value. So the value of our firm is whatever we have as our beginning book value plus the future discounted residual income stream. So in year 1, we know that on the previous slide, we know that the residual income in year 1 is 1.4, then 1.8, and then 3.175. So what we want to do is we want to discount them back to the present period. So in year 1, that would be 1.4 divided by 1.1. And it's divided by 1.1 because it's 1 plus the cost of equity, which is 10% in this case. In year 2, it's the same, but we take it to the power of 2 because it's in year 2. In year 3, it's the power of 3 because it's in year 3. And then the value of the firm, or specifically the value of the equity in this case, is $6, which is the beginning book value, plus the present value of the residual income stream. So I think actually this model might be slightly easier to understand than the discounted cash flow model because it's slightly less intensive. But the idea here is that instead of valuing cash flows, we're trying to value the economic profit that the firm is generating. And again, economic profit or residual income, the same thing. And the idea here is that the residual income is the income or the profit that you're making after accounting for the opportunity costs of your shareholders. And that is basically what the equity charge is trying to show. So when we're looking at, residual income and how we actually get it, the basic idea could be tied to the notion of cost of equity and return on equity. So again, if you remember in the ratio analysis week, we said the return on equity is basically the most important ratio, and then we're going to look at its components. So when we're looking at the residual income, the easiest way to figure out whether you have positive or negative residual income is to just compare your return on equity to the cost of equity. If your return on equity is greater than your cost of equity, it means that your residual income is going to be positive, so it's greater than 0. If you have positive residual income, it means that the value of your firm will be greater than the book value. So what does this mean? Well, basically, if we go back to the previous slide, we know that the value of the firm is equal to the book value plus the discounted future residual income. If this residual income is positive, that means that this will essentially be added to the $6. If this, on the other hand, is negative, so you're essentially making an economic loss in the future, it will essentially be subtracted from the $6, and the value of the firm will be less than $6. So again, if there is a return on equity is lower than the cost of equity, you effectively have negative residual income. If you have negative residual income, the value of your firm will be lower than the book value. So in many ways, if you believe that your return on equity will not go above the cost of equity in the future, you should just cease operations, sell everything off, because it makes no kind of point to continue operating because you're effectively destroying shareholder value. Questions, easier or harder?
Makes sense.
Makes more sense? So it's a bit less technical at least. So again, if we're thinking about it from a single stage point of view, in a sense that we're going to look at it one period and we're going to assume a constant growth rate. So if we want to just look at a constant growth rate from a residual income perspective, so looking at it more of a perpetuity perspective, we can use the formula up here, which basically looks at your book value plus your return on equity minus your cost of equity divided by your cost of equity minus the growth rate, and this is all multiplied by the beginning book value. How would you kind of, implement it? Well, again, in this case, we have all the information here. We know the book value of equity per share is $30. The return on equity is 18%. The required return on equity is 12%, and the residual income growth rate is 8%. So basically, go to the previous slide and plug in all these numbers into the equation, which means that, again, we start out with the BO, which is book value. At the beginning, book value per share is $30. We plug it in at the beginning and at the end of the equation. We know that our return on equity is 18% and our required return on equity is 12%. So essentially, this is our cost of equity. So again, this is ROE minus the cost of equity, and then divided by the cost of equity minus the growth rate of 8%. If you've plugged all that in, your value per share is $75. Essentially, you get this at the very end. So again, when we're looking at a perpetual growth model, when it comes to the residual income model, it's pretty simple to understand, hopefully. Now, the most important part when we're looking at, residual income model, and you'll see that when you apply this, for example, in your workshop for your own company, the way you actually discount each period, it's very similar to the cash flow model. The main difference is at the end, you add the beginning book value. That's really the major difference between these two models in terms of actually how you calculate them. But again, they're both looking at a return and you're discounting them back to the present period to understand what the value of the firm is. Now, the other issue to consider is in terms of, the persistence of residual income. So we talked about, persistence in, the accounting analysis week, and even, when we talked about forecasting. And persistence is essentially the idea that we're going to have persistent earnings over time. So essentially, it'll not just be a one-off increase in earnings, it will persist over time in the sense that we can expect it to continue on forever. So when it comes to residual income, is basically what we're saying is that if we were to look at, let's see, at this equation here, from a long-term perspective, do we expect the return on equity is always going to be higher than the cost of equity? So if we're earning, in this case, what do we have as example, 18%, and the cost of equity is 12%, if we assumed that this will persist, then we can make this assumption forever, which we've had. So in this scenario, we made the assumption that this will continue on forever. So we're assuming that the 18% return on equity and 12% cost of equity will persist forever. So this positive residual income will always be there. But technically speaking, we know that there are things like mean reversion and all these kind of competitive forces, which means that over time, most companies find that the difference between these two numbers, so essentially their residual income, decreases over time. Because again, people see that you can make more than just the cost of equity. They see that you're doing really well. They enter the same market, and competitive forces basically drive your return on equity downwards, which is really the idea of trying to incorporate a persistence factor into the equation. So again, you could have the scenario that the RI, or residual income, is going to be constant forever. Or you can assume that the residual income is going to be zero at the terminal period. So basically, if you, for example, in your project are assuming that you're going to be forecasting 5 specific years, at the end of year 5, you can just assume that the residual income is going to disappear because of competitive forces. But you could also just assume that our residual income will gradually decrease to zero, where basically return on equity and cost of equity are going to meet. So basically, we're going to assume that, generally speaking, that RI gradually declines to a constant level, where return on equity is above R to some extent. So the way to try to model this kind of persistence into the equation is to use a persistence factor in the equation. And again, what we're looking at, I guess, the difference between high persistence and low persistence is, if you think about it from a high persistence point of view, what would mean that a firm will tend to have high persisting return on equity? Well, one thing is that they actually have a low dividend payout. And again, this is one of the questions from midterm kind of related to this, where I asked what would happen to future profits if the firm started paying out dividends. I got a whole bunch of answers, and some were a bit more right than others. But the general idea is that if you pay out dividends, it might be seen as good by the market, but it means that you're reinvesting less into the business. If you're reinvesting less into the business, it will hurt profits in the long term. So in this case, if you have a low payout, it means that your residual income will technically persist over a longer period. If you've historically had high industry ROEs, so essentially the industry in general have high return on equities, it indicates that there might be high persistence. On the other hand, if you had extreme levels of return on equity, which are not normal, well, then the persistence factor will be lower. Or if you might have special items that are just inflating current residual income. Or if you might have extreme accounting accruals, which again are just inflating current earnings and so on. So the idea here is to trying to figure out, will our residual income persist over time? And to incorporate this into the model, you'd use the equation above. So again, a bit complicated, but the main big difference here is that we're introducing, I believe this is, gamma. Does anybody speak Latin here? Latin. Don't you guys get taught Latin more? Let's just call it gamma. So I'm pretty sure it's gamma. Oh yeah, but yeah, so we're going to be using gamma here as the persistence factor. And the idea here is that we're essentially going to plug it into the formula above to account for how quickly will our residual income erode over time. So if we believe that our residual income, so again in our example previously was 18%, is going to persist forever, then we can say that the residual income and the gamma in this case is going to be 1. Basically, it will not deteriorate over time. 0, on the other hand, means that it will essentially persist. It will not persist after the initial period, so essentially it will decline to 0. So our residual income will be 0 after the first period. But if we're looking at, I guess, what tends to happen in reality, if you do this exercise for a large number of firms, what you'll find is that it tends to be around 0.6. So firms' residual income decrease over time, but they don't necessarily become 0. So I guess the average in reality is about 0.62. So let's say we wanted to use this example and instead assume 0.6 as a gamma in this particular example. So in this example, we have beginning book value times 0 of $20. Then we know what the residual income in year 1, 2, and 3 is. So 50 cents, 85 cents, and $1. And our required return on equity, or the cost of equity, is 10% in this case. And again, we'll find out here that the firm continues operations after 30 years. So what we can do here is to try and figure out what is the value of the firm according to this little structure. So what you can see first is that we're looking at year 1 and 2, similarly to how we've done it in examples in the past. So we're just taking, again, we're starting with the beginning book value, because that's going to be what we're going to be adding the residual income on top of. And again, we're discounting year 1 residual income and year 2 residual income. And then finally, for year 3 residual income, and we're assuming that the firm will continue onwards, we enter the gamma into the equation to show the persistence factor. So we know that this is the residual income in year 3, but do we believe that this will persist into the future? So 0.6 is that means that we're going to assume it's going to persist into the future, but there will be a decline over time. If it was 0.2, it would be a more drastic decline. If it was 1, we would assume that this $1 will just continue on forever. So essentially all you do here is plug it into the equation to figure out what the value per share is. So again, you basically just plug in 0.6 to figure out what the, I guess, appropriate discount rate is, and you get the value per share at the end. Again, in your final exam, you'll also get a formula sheet, so I don't care the fact that you will memorize this formula, but you need to be able to apply it, and more importantly, understand what this actually means. So why do we need to consider persistence when we're talking about residual income? Because again, residual income basically just means that your return on equity is greater than the cost of equity. So the idea is that technically speaking, if you have high levels of return on equity, over time it will mean revert back to some form of a norm or a mean within the industry. So we need to account for this reversion somehow. So if we want to compare, I guess, the residual income model and the discounted cash flow model, again, when we're looking at how they're, I guess, calculated, well, when we're looking at the residual income model, we start off with the book value plus the present value of the residual income stream in the future. Whereas in the cash flow model, we're just looking at the present value of cash flows. And these cash flows are both the early cash flows and the terminal value cash flows. But basically, we're just looking at cash flows. So again, if you want to just compare these two equations, one places a larger weight on current book value, and the other one places a larger weight on later cash flows. That's real big difference here. In theory, if you have a very simple example of a business and you assume very simple things, they should give you the exact same number. But because of various accounting issues, and I'll kind of go through this, they tend to give you quite different numbers. So if I look at, I guess, residual income, some of its strengths is that basically you can value firms that some of the other models might not be able to value. So again, the idea here is that it puts slightly less weight on the terminal value, which is a good thing in the sense that the terminal value is where you assume a certain growth rate into the future forever. Because that assumption is very, very sensitive in the sense that you're basically just guessing, putting a slightly less weight on that assumption is a good thing because you're relying less on very long-term assumptions. Again, we tend to use accounting data, which is a good thing, but it might actually be a bad thing as well. And it's also really good for firms that are not paying dividends, so you can't use things like a dividend valuation model. And it's useful for firms that are not paying out, or I guess not generating any cash flows. So if you remember when we talked about the discounted cash flow models, we said that we needed to adjust it for non-operating assets. So if we had a lot of cash, we need to actually add it back at the end. In this case, if we had a lot of cash, well, it would actually be picked up in this book value at time 0. So essentially, we don't need to consider that. Because again, the cash would be incorporated here, so our non-operating assets would still be accounted for here. So again, the strengths are really around the fact that it's not focusing on cash flows, it's focusing on economic profit, and it's focusing on things that we tend to have more readily available to us. And again, even these just focus on the economic value where you're comparing return on equity versus the cost of equity. It's a really nice way to think about, are we actually creating shareholder value or not? And again, when we think about weaknesses, well, again, technically accounting data is a strength because it's observable, it's there. But it's a weakness because if the accounting data is biased, the whole model more or less falls apart a bit. And you'll see kind of how. So the second issue is really around the fact that it kind of assumes that the cost of debt is going to be equal to interest expense. And this might not always be the case. But again, when we're thinking about the major weakness, it's really around all the various accounting issues. So if I just go back, let's see. So basically, when we're looking at residual income here, we're basically almost basing it on current accounting information to some extent. So this return on equity would be based on, again, net income divided by the total, I guess, average total equity and so forth. Our BT minus 1 is current book value. So our equity charge is going to be based on whatever our current book value is. So if we have a bunch of accounting issues that biases our book value downwards or upwards, it means that our equity charge calculation will be wrong. And if that's wrong, well, then the residual income is wrong and so forth. And again, there's a whole range of reasons why this might happen, and I think there is a slide about that. So again, when we're looking at the residual income, it's very, very sensitive to any issues surrounding accounting practices. So one thing is it does assume a clean surplus relationship. You might have covered it in some other class maybe, but if you haven't, the clean surplus relationship just means that the ending book value should be equal to the opening book value plus profits minus dividends. So from a historical accounting perspective, this was always true. But because we have a bunch of various more complex regulation these days around primarily financial instruments and foreign exchange translations, sometimes you might actually have a change in book value that is not reflected in the profit. So if you've had a huge increase or decrease in the fair value of your financial instruments, it doesn't necessarily need to hit your profit, but it will change your ending book value, in which case the clean surplus relationship is not valid anymore. And the second thing is really around any balance sheet adjustments. So these could be things for like leases, less of a problem these days because now there's not going to be an option to keep leases off balance sheet. But probably even more important is around intangible assets. So let's say you have a firm like McDonald's, whose assets include things like the McDonald's brand name. The McDonald's brand name under their balance sheet is non-existent because it's something that they've internally generated over time. From a balance sheet perspective, their assets are technically understated because they don't account for the brand value of McDonald's. If the book value is understated, it means that we will understate the equity charge. We will essentially understate how much shareholders expect from McDonald's in this case. And again, when we understate that, it means the whole model will be biased. And again, similarly to, this is not necessarily just about the residual income model, but non-recurring items or any kind of practices, such as aggressive accounting practices, that might increase profits in this year, but they might only be temporary. So again, if you have aggressive revenue recognition, yes, it's going to increase your profits this year, but it's going to reverse in the future because again, if you increase it artificially this year, it's going to decrease it in the future. And even the idea of permanent versus transitory, is the profit that we're generating going to be persistent over time or not? And then finally, things like international considerations, and that's really the idea that across different jurisdictions, these issues will be not equally, important. So some countries have huge problems with leases in the sense that they tend to keep leases off balance sheet. Other countries have slightly different rules for how you adjust and account for intangible assets. And if you have large international differences, it makes it very difficult to compare residual income valuations across borders. Questions? You look so sad. Easy specifically. Yeah. Questions? Do you guys understand? Confusing?
Just, you know how you said they assume a clean surplus relationship, right? So every single time that there isn't a clean surplus relationship, does that mean the residual income will be
Yeah, so it just when you don't have the clean surplus relationship, because technically the whole model, again, it's when somebody created even this model here, they would have had a huge number of equations to try to prove that this is the true relationship between the value of the firm and all these various factors. One of the underlying assumptions between this, for this to be correct, is that there is a clean surplus relationship. In the sense that any changes in book values of the firms can be attributed to profits. And the reason for that is really that if we're looking at what we're valuing here, if I go back to a much simpler, let's see, what we're valuing here, let's see, so what we're valuing here, let's say here. So what we're valuing here is really the earnings of the firm, and we're looking at the book value of the firm. So if any changes in the book value, so increases or decreases, are not able to be explained by the earnings, then this whole model kind of falls apart because that's the only two things it cares about. It cares about the book value and the earnings, because it assumes that any increases in book value, in earnings that are not distributed to the shareholders are then also going to increase our book value of the firm. But again, it's a much more theoretical argument.
Which one's more common in practice, the free cash flow?
Yeah, so the free cash flow one is much more common practice. It's the one that you would always use. This one is becoming much more popular these days, but it's still that if you're looking at a real valuation, they'll always do a discounted cash flow model. This, they tend to do a whole lot more when they go into consulting. Consulting firms tend to focus on this more because it focuses on economic profit, in the sense that we're focusing not on how much profit you're making, but are you actually providing value to the shareholders. So from a consulting point of view, this is much more interesting. Yes?
So is any positive number like a good number then, or how do you put it?
Yeah, so when you're looking at residual income, a negative number is a bad number because it basically means that you're destroying shareholder value. But just like with any model, the larger the number, the better, assuming that that number is going to persist over time. So if it's a one-off, it's not that necessarily going to be that important, but if it persists over time, then it's better to have a larger one.
How do you estimate the persistence factor?
You don't estimate it in any way scientifically, you basically try to figure it out yourself. So you're trying to basically guess in a sense that you're trying to understand, again, go back to this slide, you're looking at indicators that basically could help you to figure out if the residual income will persist. So again, if the firm is not paying dividends and it's reinvesting a lot into the firm, it generally means that the residual income will increase over time, or basically will persist over time. Whereas if the firm keeps paying out all the profits and dividends, it means that they have zero to reinvest, which means that they're most likely will decline quite quickly. And again, even I guess the idea of extreme levels or one-off items that might increase current net profits, if those are just one-off items, it's not going to persist over time. But it's more or less a guess, and you're just trying to say like 0.75 instead of 0.5, which one is more reasonable, but there's no correct answer here.
Okay.
Well, that persistent factor, like, is it going for like when you put like 0.6? Is that just for like the next year, or is that what?
No, that will be forever. So in the sense that,
Perpetuity?
yes, it's kind of like a perpetuity, and you're basically assuming a decline in the perpetuity to some extent here.
Yeah.
So the big difference of using this formula instead of a perpetuity formula, that instead of assuming a growth in residual income, you're assuming a decline in residual income by a certain rate.
Sure.
And the higher the gamma, the less of a decline. The lower the gamma, the more drastic of a decline. Yeah? Easy. And it stopped raining, that's awesome. Again, we're done for today. So on Thursday, again, remember there is a homework for Thursday. So make sure to do it, because on Thursday, once you're done with the homework, you'll be able to value your firm and figure out what the value per share is. And then you can start to compare it against the offer price to figure out whether you think the firm, the offer was reasonable or not. So was it fair or not? All right, I'll see you on Thursday.